The AP row, there's a decrease. Is it typed in as positive because it's in parentheses? Okay, so if a number is in parentheses, then that means that it's a negative amount, not a positive amount. So now in the left-hand column where I say increase / decrease in accounts payable, so let's see here. If AP goes up, cash flow goes up. If AP decreases, cash pay, no, let me think about that. Yeah, if AP decreases, then cash flow decreases. The parenthesis is a negative amount. Yeah, a negative is a positive. Yes. And the cash out for the bank loan payments, do I sum the change in the loan balance from the balance sheet and the loan interest? No, loan principal is treated differently than loan interest. Loan interest is an expense that lives on the P&L. Principal is a debt, in other words, a balance sheet item. So you are concerned for the purposes of this exercise with only the principal portion paid back to the loan. The principal portion the change in the principal portion is what will show up on the cash flow statement as a financing cash outflow.
Like a robot. Okay, so it's time for us to get started here today. Thank you all for joining us. It's exciting times for us this week. It's Portland Beer Week here, so we were just talking about all the many beer festivals going on throughout the week.
Yeah, so there's like something every day.
Yeah. Multiple things every day. Exciting times. So today we're going to be talking about sources of capital for a beverage company. You may have by now watched my video on securities law, which is good background for this because securities law is the backdrop for all of this kind of information. But Maria and I are just going to be chatting with you today about different sources of capital, how to approach investors, how you might structure an equity or a debt investment, and a couple other elements. And if you have questions throughout it, please just type up on there and drop us a line, and we'll try to answer it the best we can. Otherwise, we'll be just going through our slides and talking about these issues.
One thing that it seemed that a lot of people had an interest in the comments for the introductions is how do you, once you've got your business plan together, how do you actually talk to people about giving you money? And we'll go over that today.
And our ideas will be just that, ideas. It's a personal touch for these things. It's depending on who you're approaching and how well you know them and so forth. But we'll get into that more in more detail. Let's start by talking about what these various sources of capital are. And let's start with the most simple one, self-funding. If you have a savings account and you have a lot of money in that savings account, it's a very good thing. And you can use that to start a business. I don't think we need to go into that in any depth because A, that may not be your situation, and B, if you do, it makes things really simple. You just pull money out, put it into your business bank account, and there you go.
Yeah, one of the things you probably realized by now is that it takes a couple $100,000s to really get up and running properly, at least for the first year of business. So there's not that many of us that are just walking around with that in our bank account. But if you are, good for you.
If I were one of those, I'd be starting my own brewery. So a couple other ways to self-fund other than your savings account, and I've had a couple of clients do this, is to basically pull money out of your 401k. Now, this is something that a lot of people do to start a business. They borrow against their 401k. It's very risky, of course, because you are putting your entire retirement fund or a portion of it at risk and basically betting on yourself that you're going to be able to put that money back in, or else at least have your business be your retirement fund. There are some rules that go along with it. There are going to be maximums you have to deal with. I believe the maximum you can borrow against it is about 50 grand. And you're going to have to pay back that loan plus interest, and usually it's going to be a 5-year term, somewhere around there. The nice thing is the interest that you pay back generally goes back into the 401k, so you're paying yourself that interest. Just real quickly, another way to work with your 401k is a type of business funding called rollover as a business startup. And I've actually seen quite a few of these popping up recently, where you actually create a 401k plan for your own business. So you are managing the 401k plan, and then you roll over your 401k funds into your own 401k plan, which then invests in your business. So you're not borrowing from your 401k, you're actually using your 401k money to get your business started up. And it can work really well, but again, you're putting all that money at risk, and in this case, probably every penny of it at risk. And it comes with a lot of compliance difficulties, a lot of maintenance, a lot of reporting, and if you don't do that proper reporting, all that money is going to be considered a distribution of your 401k, and you're going to end up paying a ton of taxes on it.
Mm-hmm. And penalties probably.
And penalties, yes. There's also a similar method called the self-directed IRA, but it's kind of the similar concept, but with an IRA instead of a 401k. So friends and family we mentioned.
We've got one question about,
sure.
So returns to that 401k. Why, if you're talking about the self-directed 401k, which is where you take your personal 401k and then you start a company 401k with that, then basically like when you had your regular 401k, that's theoretically invested in the market and you've got different mutual funds that's invested in. Well, here, instead of it being invested in a variety of different things and have a variety of different risk profiles associated with them, you're just taking all your eggs and putting them in your own basket. And so if your brewery goes bust, then everything just goes up in smoke. So it's dangerous because you can't hedge your bet, so to speak. With the traditional selection of investments, you can sort of have different portfolios going, a varied portfolio of funds, and here everything's just in one company. So returns would go back into it theoretically, but it would probably take a really long time for you to generate enough cash that you're gonna provide a return on that original investment.
Exactly. And another quick thing to note on those, they're expensive to set up. They take specialists to set up. There aren't many. I don't set them up. I don't know very many attorneys who do, but there are some specialists out there who do them, and they generally charge about $3,500 to $5,000 just to get your corporation started up and get the funds rolled over into your 401k. So a little bit of upfront cost there. So friends and family, we just want to point out here that it's a good route to go. If you have some friends and family that have money and want to grow your business, You can do these either through loans from your friends and family or through selling them equity. You often will get friendlier terms out of your friends and family because they're just as concerned about your well, maybe not just as concerned, but they are more concerned about your financial well-being than just any other third-party investor might be, or a bank or somebody like that. So they might be willing to hook you up with some good terms. You do have to, I mentioned this in the securities video, you have to treat friends and family as individuals who are purchasing a security. They're not exempt from securities laws, so you have to go through that whole process. But generally, the discussion on family security, friends and family securities will fall under all of our other discussions today about equity and debt. Institutional financing, maybe you can touch on that a little bit since you talked about the SBA.
Yeah, so institutional financing is dealing with a bank, is what that is. So if you're going to go the route of working with a bank to facilitate an SBA loan, so basically the government is helping fund your effort, but you're going through a bank, so it's like kind of a government bank combined effort to give you money. Or if you're just going the traditional route with a traditional bank loan, that's another form of institutional investing. But institutional investing just means basically working with a bank or some other financial institution.
I'll answer Christian's question about certified investors. I think you're talking about accredited investors, and it depends on whether you have to have accredited investors depends on what kind of securities exemption you are funding your company under. There are some exemptions, the 506 exemption, which requires that, in some parts it requires that all the investors be accredited in order to fit under that exemption. And if you fit under that, you don't have to worry about state securities law. But if you go under the 504 exemption, you can have unaccredited investors and or a mix of unaccredited and accredited investors. But you're going to have to comply with state securities law. And I go into more detail on that in the video on securities. So state municipal development funds, all we'll say about that is they're available. And we've worked with some breweries who have taken advantage of those, and they can be great. They can have very friendly terms. You might even see some interest only or no interest upfront terms. And what we're talking about here is maybe you're opening up your beverage company in an underserved area of your city, and there's some kind of development fund in place that's going to allow you to get a favorable loan. Often those loans are going to be second position loans, so maybe you get a bank loan and then you back that up with a municipal development fund loan. And they're not usually going to be huge loans, they're just going to be sort of stopgap loans.
Yeah, sort of bridging anything that your big loan isn't able to cover if your needs go beyond that. A lot of times those are put forth by city programs that are trying to give a little economic vitality to certain areas.
Yeah, and I love the question, is there anywhere in PDX that is underserved? Yeah, Lents is a good area. When I say underserved, it doesn't necessarily mean that there aren't any breweries in that area. It might just be an area that the city has targeted for some kind of economic development. So, somebody who got a municipal loan in an area that's definitely not underserved, it's a very doing well area with affluent people living in it, but they were able to get that loan because they just happen to be in an area, this broader geographic area that has these programs available.
Yeah, and it's hard to give you more specific information because it just varies depending on whichever city you're in. That's a good question, Wyatt. I don't know if McMinimans does or not.
I don't. I seriously doubt it because they probably fund everything themselves at this point. I'm not sure.
Yeah. So for those of you guys who aren't familiar with McMinimans, the McMinimans brothers are brewers, and they're located in Portland, and they kind of have this empire now where they have all these different locations, and their shtick, their thing, is that they go into usually a historic building of some sort, and they will rehab the building and usually put in a brewery or a distillery. They produce wine as well. And they also have a restaurant component, and then they got, entertainment as well that might be part of the center. And they've gone in and rehabbed old schools, churches, all different kind of historic buildings. So, and they're just all throughout the Northwest now. And they have a great business model. I love their business model because they buy all their own property and they make all their own beer and serve it in-house. So the margin that they reap on that is really a high margin that they're able to keep, and they're not frittering away money on a lease. They own all of their own property. So if you can pull off something like that, it's genius. It's great.
I think I heard they're actually doing an equity crowdfunding deal up in Seattle on a new hotel. So they're taking advantage of some of these interesting securities laws.
Yeah.
For any of you folks who are not in the Portland area, I suggest you come here, visit a McMenamins, and then steal the business concept and take it to wherever you live. I don't know why more people aren't doing this.
Yeah.
So moving on to the next point there, going to Edge Trail on Thursday. I wish I was too. Government grant programs, I have that on the list because it can be a source of capital for some startup businesses. I've never heard of a brewery being able to take advantage of one of these programs, but it doesn't mean it's not possible. Usually these are going to be available where there's some kind of need that the federal government or sometimes the state government feels it needs to fill, such as maybe a minority-owned business or something like that. You can get a grant for it. Angel investors, we kind of lump the next two together even though they're very different. Angel investors and venture capital are often more often heard of in sort of the tech startup scene, but they certainly do exist in the beverage world. I've worked in a couple of those situations, and the biggest difference is angel investors are going to be on the front end usually. They're going to invest in your startup company. They're going to throw maybe $20,000, $30,000 at your company, get a little equity out of it, not take any control. They're not interested in control necessarily. They're just interested in seeing where you go. They believe in your business concept and they want to put some money into it and see where it goes. Venture capital, on the other hand, those folks are going to want a lot of control in your company. They may be putting more money into your company. It's usually going to be later in your company's life. And you just have to be very mindful of who the venture capitalist is who's coming to your company, because they do often want to pull some strings.
And a lot of times it'll be a controlling interest that they buy.
Yeah.
Over 50%.
Yeah. And it comes along with some other requirements, such as they generally require that you're a corporation, so your LLC will have to go, and they're going to want somebody on your board of directors of that corporation, so it can be rather stringent requirements. But for a company that's looking to go from small and closely held to the big time, venture capital can be a great way to go.
Yeah, and especially if you aren't necessarily married to your business and you're sort of looking for an exit strategy anyway, if that's your plan, then that might be a good route.
When dealing with equity investors, what are the best types of entities to organize? LLC, C Corp, S Corp. LLC's taxes, C Corp, S Corp ownership. We just gave an example of equity investors in the venture capital world where you are almost always going to have to be a C Corp. But other than that, there's a lot of room for flexibility. So if you're just going the friends and family route, you're going to have some investors involved that you know and have a relationship with. The LLC can be a fine model. The S Corp can be a great model. C Corp is generally not going to be the best model just for tax reasons. And the S Corp, whether an LLC or a corporation, the tax treatment of an S Corp could give you some benefits in the future.
Yeah, so, and another thing about LLCs versus corporations, and specifically S Corps, because that would mean you have a flow-through entity. So the LLC is, by and large, way more flexible in terms of what you can do with your agreement, and also how you can distribute money. When you have a partnership, there are different ways that you can distinguish the ownership. So everybody has a profit percentage, a loss percentage, and a capital percentage. And those can be different numbers. So for example, you might have two partners, partner A and partner B, and the profit percentage might be 50-50, the loss percentage might be 60-40, and the capital percentage might be 30-70. They don't have to be the same thing. So you can kind of manipulate that and massage it and help you really finagle some crafty operating agreement language. With S corps, there can be some tax advantages there, and in my mind, I think of S corps as being simpler. I think they're simpler to comply when it comes to the compliance piece in terms of the tax return. It's simpler than an LLC is, and certainly the tax law associated with an LLC is more complex than an S corp. With an S corp, distributions have to be pro-rata to your ownership share. So if you have different investors, you're stuck with like one level of ownership percentage. So if you have two partners and it's 60-40, it's 60-40. And if you want to give away $1,000 in distributions, partner A has to get 600 and partner B has to get 400. You can't give 500 to each. So that's what I mean by being pro rata with your ownership shares. So in that way, S corps are much more limiting. I'd say 9 out of 10 breweries or any sort of beverage company that I see is formed as an LLC, specifically because it has more flexibility for achieving the goals that you want with your partnership agreement.
There's a lot of folks starting these companies are putting in a lot of sweat equity, and they're going in where their investors are going to be paying more to start up or to purchase their shares than the founder is going to be paying, and the LLC allows you the flexibility to do that kind of thing.
David asked about a co-op. I have never come across that.
I've never dealt with that in the beverage company. I've never formed a co-op at all. So
yeah, and I don't even.
You can answer that question.
Yeah, I'm not even sure that that's a thing.
It's a thing. I suspect that Christian is correct that it's that state law is going to be governing quite a bit of that. So you have to take a look at state law.
A nonprofit public benefit corp. Right, yeah, ex novo, they are. So ex novo is an example of a brewery it's a nonprofit brewery, and that's perfectly doable. You can be a nonprofit entity and still sell things. That's doable.
The catch with the nonprofits are some on the board of a bar in town here that's called the Oregon Public Health. And we sell food and beverage and donate all the proceeds to profit. And that's
all the proceeds to charity.
Or I'm sorry, all the proceeds to charity, not to profit. The opposite of that. So the problem with it is the IRS views those companies as competing with for-profit entities. So they're generally not going to give you 501c3 status, and so you don't get those friendly tax exemptions that come with it, and your contributors don't get those tax exemptions. So what you can do, what you often have to do, is offer your product for a donation only if you're going to try to get that status. I'm not sure how ex novo is handling that, but generally you're going to have to put it on the menu as something that's for donation, and that's going to allow you to get tax exempt status.
Jason asked about, is there a point when a C Corp is preferred? I mean, so a C Corp is great because it gives you kind of unlimited ability to raise funds because you have stock that you can sell. So it makes raising money a lot easier than other forms of an entity, but you do have the double taxation factor. And Jason, I know that you're in accounting, so you're probably familiar with what I'm talking about. For the rest of you guys, if you're not familiar with double taxation, the concept is that the business itself gets taxed, and then when a person who owns stock in that company receives their portion of earnings, it gets taxed again at the individual level. So you get taxed once as the business, and then everything comes down to the owners, and it gets taxed a second time there. So that's a big disadvantage. However, it does ease the ability to bring in people, investors into the company, raise money, and it's preferable for venture capital situations. So I'd say that most businesses, when they really go big, are C Corps, but it's a long runway before you're ready to get there. I'd say, I mean, I don't know anybody off the top of my head who chooses to start as a C Corp.
Yeah. Okay, so moving along to the last few we can run through pretty quickly here. Crowdfunding. Hopefully you all watched the video up yet. You all watched the video with Vagabond Brewing talking about their experience with non-equity crowdfunding, such as Kickstarter. And these can be great programs for getting some money in. You're not selling equity, you're just getting money in from people who are interested in your business, and you give them generally something in return, such as a t-shirt, or you name a beer after them or something like that. So you'll be learning a lot about those when you do your homework for this session. And this is just another note on that. It's not to be confused with equity crowdfunding, which is a highly regulated portion of securities law. It's a new law that's coming into effect. I discussed that in the video, where you're going to be able to bring in small amounts of money from large numbers of people, but it is highly regulated. It is highly difficult to comply with, so just be mindful of that. But for some beverage companies, it could work out really well. In fact, beverage companies are being used as sort of the model for the type of business that these things could benefit, that this new law could benefit. So keep that on your radar. Trade credit is basically, it's not financing necessarily, but it's a way to benefit from your cash flow, because you might get favorable terms from some of your vendors who are providing you raw materials, or kegs, or and things like that, where maybe you get on 30 or 60-day payment terms. So you are benefiting from that product or from that supply, but you're not paying for it yet. So it's kind of like a mini micro loan that you're getting, and it rolls over a little bit at a time. So that can be really beneficial. Of course, the people you sell the beer to, your distributor, they may also be taking advantage of trade credit and put you on 30 or 60-day payment terms, which does not benefit you as much.
Yeah, the idea behind the capital management is that you want to get the money faster than you have to give it away.
Exactly. Equipment leasing is simply a way of stretching out the cost of stuff. So you're instead of putting down 100 grand or 150 grand for your stainless steel, you are leasing the equipment and basically paying it over a long period of time, either on a lease to own or just a straight up lease where you never do end up owning it.
There are, just as an accounting side note, there are specific rules around leased equipment. So just because you're leasing something and you intend to give it back to the person you're leasing it from at the end of the term, you still might have to capitalize that as if you had purchased it. So just be sure to check with your CPA on those rules.
And finally, you have your mug clubs, which is kind of like your crowdfunding deals, because you're getting your loyal customers to pay you in advance for all the good times they're going to be having at your pub. So they purchase their mug for a couple $100, and when they come in, you give them $1 off the beer or whatever. I'm sure you all know how those work, so we won't go into any more detail. All right, we're going to talk a little bit about investment structuring. So most of the beverage companies we work with tend to use either debt, so they're borrowing money from people or from institutions, or they're selling equity, or there's some kind of combination of the two. So we'll talk a little bit about the sort of the benefits and detriments of each, and what considerations go into deciding how to structure your investment.
Yeah, I just want to take a second to clarify the difference between the two. Debt is where you're borrowing money, you give it back. Equity is when you were getting money, you're keeping it, in exchange you're giving a portion of your business away, a portion of ownership.
Exactly. So the benefit, of course, with using debt is you get to keep your company. You keep all the ownership in your company. At the end of the day, you might still be a 100% owner of your company, but still have a funded company. Of course, detriment that goes along with that is you have to pay that back. It's whereas with equity, people are paying money in, and you can often use it however you please and pay it back, either according to some kind of distribution structure, or maybe just whenever you have the cash to do it. With debt, you're going to have some kind of promissory note documenting it that says when you have to pay that money back.
And of course, there will be interest too.
Exactly. And the interest rates I've been seeing on these deals, it ranges from, I've seen as low as 3%, and It can get up into the double digits, but generally I'm seeing about 5 to 9%, somewhere around there. Which for your investors, that's fantastic. You're not going to get that at a bank these days. You're not going to get that out of the stock market in a lot of cases. But it's a good, reliable investment. Depends, definitely depends. But it can be a very attractive investment for your investors. And of course, those rates, the common rates will change as the economy changes.
Yeah, and another thing about debt is that, well, like Marcus was saying, you're going to have a promissory note. It is a lot more structured. You've got timelines you have to meet and pay things back. And then also, if you're working with banks, a lot of times the banks are going to require reporting either on a quarterly or monthly basis. And that you can incur additional compliance costs, and that usually manifests with more accounting fees. So if you have a bank loan and you have to provide financials on a monthly or quarterly basis that are GAAP compliant, GAAP is a term that means generally accepted accounting principles. So that's something where you're going to have to work with somebody who knows what they're doing so that they can get it done correctly and then submit it to the bank. And usually they will want that, I'd say, within 30 days of the close of the period. So, just be aware that that's an extra expense that isn't built into the debt agreement, but know that you will have to pay. Or if you're super, savvy in that area, you do it yourself maybe, but you're going to pay either in cash or in time.
Yep. And you need to be careful how you structure your debt. Especially if you're working with friends and family, you can get pretty favorable terms on your debt. You can get some interest only, or maybe even no payment period for a year. You're not going to pay a dime, but interest is going to accrue during that time. Then maybe you have a year or two with interest only, and maybe you pay off all of that interest at the end of that period, and then after that go into paying off principal and interest. Mm-hmm. You can set up a balloon payment so that if there's some larger amount remaining at the end of the period, you can maybe go to the bank at that point once you have cash flow and you've proven your business. You go to the bank, take out a more conventional bank loan, and pay off your investors. Yeah. So there are a lot of ways you can structure it. Just be sure that it's built into your business plan how you're going to be able to pay that off, and make sure that you're going to be able to pay that debt.
And as a general rule, in terms of the term of your loan, so in other words, how long you have to pay it back, the longer the term, the higher the interest rate. That's usually the way that works out. The shorter the term, the lower the interest rate. And the concept behind that is that the longer the time period before an investor is reunited with his or her money, his or her initial investment, the riskier that investment becomes. So if I'm going to give somebody money and I'm going to get it back in 2 weeks, that's not that risky, and maybe my return will be minimal. If I'm going to give somebody money and get it back in 5 years, well, there's a lot of unknowns that can happen between now and 5 years, so it becomes a much more risky endeavor, and therefore I get rewarded for my appetite to take more risk because I get a higher interest rate back. So that's kind of the concept behind the time frame and interest rate.
Good point. Another consideration when dealing with private lenders, just keep in mind that at some point you might have to go to the bank. Maybe you're going to need more capital at some point. When you go to the bank there's a good chance the bank is going to want to have a first position lien on your assets. So they're going to want to put a lien on your equipment and on the income that derives from that equipment. They want to basically own everything, so they're going to give you money to collateralize everything. So you might build into your loan agreements with your private lenders that they will subordinate their liens to the institutional lender if the need arises. Otherwise, you're going to have a roadblock to getting institutional financing, and that can cause some problems, especially in times of capital needs.
And it can be an awkward conversation to have too. If you have investors to begin with, and maybe it's people you know, and then the need arises to go and get more money from the bank, and the bank says, we're only going to give you money if we can take first position, and then you have to go back to your investors and get them to sign a document that says, if everything goes belly up, then we agree that the bank will get paid back first, and then if there's anything left over, we'll get the crumbs, and that can be awkward. So yeah, it's always good to have that down in writing first.
Definitely. let's move on to equity. So Maria and I, before the program today, were talking about the double-edged sword of equity, where you have these people who are very interested in your business, friends, family, whoever it happens to be, who have decided to invest in your business and buy some ownership in your business. Some of them may be very helpful to your business. They may bring some expertise that you can use their advice from. Maybe you have a little advisory board of your LLC members, and you can benefit from that. The double-edged part of it is that they may think they're more helpful than they actually are, and they may think that you want them to be more involved than you want them to be. So that's when you get the infamous investor hanging around the brew house kind of guy, who wants to come in and says, "I'll do anything, I'll help you clean tanks," or whatever you want me to do, and what you really want them to do is sort of
go away,
mind their own business and act like a passive investor. So just keep that in mind when you're deciding who should invest, and we'll get into that a little bit more in the next slide. The other kind of nice thing about equity that's sort of not measurable is that sort of we're all in this together feeling of it. You get a team of people who are excited about your product and who are interested in your business, and that I think a lot of founders of beverage companies really enjoy that part of it.
Yeah, and then they become evangelists for you in the community and
Absolutely.
help spread the word and bring in people,
Absolutely.
and you have your own little guerrilla marketing force.
Absolutely. And then the economic advantage, the structural advantage of equity is that, like we talked about a little bit ago, there's no fixed repayment plan unless there's something written into your distribution structure. You're going to have some flexibility to be able to reinvest in your company. So you're going to take your profits and expand, buy new equipment, hire employees, whatever you need to do to expand, which is going to benefit everybody because it's increasing the value of your company. Or you have you can take profits and put them in a cash reserve account and build up some nice cash reserves to be there for a rainy day or during the slow times.
Yeah, that is a nice thing about equity, is that it allows you to kind of take your time as you grow. If you feel like the time is right to make an expansion, you have the wherewithal to do that. Whereas with debt, you always have this sort of extra fixed expense hanging over your head, and you have to cover that expense every single month, or on some sort of periodic schedule, and it becomes another component of overhead that you have to cover every single month. Yeah. So yeah, equity provides a little more freedom for you to sort of move at the pace that feels good for your company.
Right, but it does come with a price. You get things like some of your investors might expect perks. They're going to get free food, free beer. You have to manage that up front and be very clear about those expectations. If your business fails, it can be very disruptive to relationships that you've established with your friends and family. They've put a lot of stock in you that you're going to succeed, and if you don't, they may have some concerns about that and may affect your friendship. One of the primary difficulties, I think, with equity is the founders always want to get their equity back at some point. I rarely work with somebody who doesn't say, "Hey, if things are going well and I have the money and I've generated enough income, what if I want to just buy back my shares?" Well, that's great, but your investors may not want that, because in good times they're going to want to benefit from those good times. They're going to want to stick with the plan. So if that's something that you're interested in, if you want that buyback right, you should build that into your plan up front, put it in your term sheet, make it very clear to your investors that this is going to be part of the plan, so there aren't any surprises there. And just a couple of structural considerations with equity. Equity can be structured so that it's more investor friendly. You can set up what some people call priority returns, which means your equity is going to be paid back not based, your distributions are going to be paid out not based on your ownership percentage, but on the proportion of contributed capital. So if your investors put in more money than you did to get their ownership, they're going to get that money back sooner than you're going to. And then once everybody's capital contributions are paid back, then you start really reaping the benefit of being a founder, where you get your distributions based on ownership percentage. Investors find this to be very attractive because it gives you as an incentive as a founder that you're going to distribute funds sooner and you're going to pay them back sooner. That's it for that slide.
And the debt equity hybrid.
Oh, the debt equity, yeah.
Yeah, that's actually a really pertinent thing that we're seeing a lot of people take advantage of, is this idea of doing a mix of debt and equity. So the idea is I'm starting a brewery, and I come to my investors and I say, looking for investors in the brewery, and I'm going to sell you 1% of my brewery in exchange for $6,000. So that's the deal, but the hitch is you also have to give me another $6,000 of debt, and I'll pay that back to you according to such and such terms. But if you want in on the brewery as an owner, you have to cough up the debt money too. So the thing is that you get $12,000 up front instead of $6,000, but you only give away 1% of ownership, and then you pay back the debt over time. And that is, I really like that way to go. I think there's a lot of benefits to it, and we've seen a lot of people going that route lately.
Yeah, and private loans are tough to find. It's a hard argument to say, give me a private loan and bet that I'm going to succeed on this. So that little extra bit of equity really is a nice incentive for investors.
Startup companies get an accurate valuation of the business. That is a $1 million question. There's not really, there's not a formula to go by. Some people consider the amount that you spend on equipment being a baseline for valuation. Some people will project sales for the first year, 3 years, certain period of time, and they'll use that as a baseline evaluation, and then you might do a certain factor times the amount of sales, so 2 times sales or something, or you take projected net income and you do a factor times your projected net income to come up with a valuation. But the God's honest truth is you're just pulling a number out of thin air because you have nothing to substantiate it. The most substantial thing that you could base it on would be the value of equipment, because there's an actual price tag associated with that. So at least that's something that you can really pin a number to. But there is no bright line guidance to how to create your own valuation. I'd say the best you can do is look around what's been done before and get some idea of best practices in the business. But unfortunately, there's not kind of a right or wrong way to do it. I know it's probably a vague answer, but
it's largely just what the market will bear. What are your investors willing to pay? And investors can do the math. If you're selling 1% of your company at $10,000 per share, and you're raising a total of $500,000 in capital, they can do the math that they're buying based on $1 million valuation, but only getting a company that's worth $500,000. That's what we call dilution, and that is a 50% dilution, which is some investors are going to be scared away by that, and others will be okay with it because they see the potential value in their investment.
And the other thing that investors don't know in that situation, they don't know how much you're putting up personally. So if you're going out to raise $500,000, in theory, you could also be planning to put in $100,000 of your own, so then the valuation would be $600,000. So I mean, there's parts of it that they won't always know unless you tell them.
Which you should. I would suggest that you do tell them that. And with that valuation, one thing that we always include in our disclosures to investors is how that number is arrived, or not how the number is arrived at, but the effect of that number. The fact that their investment does have an immediate dilution to it. You want your investor to realize that right up front, so that there's no chance of there being any kind of misrepresentation of the value they're getting. Okay, moving along. I think we're going to buzz through some of these. We've already talked about some of this. We can get through this pretty quickly. Who should your investors be? Like we discussed, friends and family are great. They'll give you some favorable terms. They're going to be good members of the team, hopefully. just make sure that they are friends and family who have the means to be doing this. Just like any investor that you get involved with, you need to make sure that they can afford to invest. The worst kind of investor is the kind who is going to be looking through couch cushions for money to invest in you, or liquidating a 401k or something like that. You want people who can afford to lose their entire investment, basically. And you're going to want people who you have a pre-existing relationship with. And this is really important under securities law. You need to have that relationship in place so there's an assumption that these people have access to you. They know you well enough that A, they trust you, and B, if they have some questions about the investment or need any information, they're comfortable enough that they can approach you and ask you those questions. And then the accredited and sophisticated investors, we've talked about that a little bit. Depends on which kind of securities exemption you're going under, but the accredited investor is basically somebody who has a net worth of $1 million or more, not including their primary residence, or who makes $200,000, has made $200,000 over the past 2 years and expects to make the same in the current year, or if they're married, it's $300,000 for the couple. That's an accredited investor. They're the best investors because they get you into these advantaged, these beneficial securities exemptions, and they clearly have the money to invest in your company. So there's just going to be little question of whether they knew what they were getting into and whether they could afford it. Sophisticated investors, as I described in the video, is more of a vague term, but just make sure that your investors know what they are, that the investors know what they're getting into, that they're sophisticated enough to understand their financial situation and understand the documents that they're reading, or that they at least have hired a professional to go over it with them and achieve that sort of sophistication. Anything to add to that?
No. So this next slide, we heard a lot in the intros from you guys that you were curious about how to approach investors. So some do's and don'ts of this under securities law. It's kind of Marcus's realm, so I'll let you take that.
Sure. So avoid advertising general solicitation. Almost every securities exemption, you cannot advertise or generally solicit. There are some new rules out there that allow you some general solicitation for accredited investors, but I can't think of any situation where you can just generally advertise and solicit non-accrediteds. So be careful of that, and that means no posting on Craigslist, no posting on a website, no mass mailings, no public speaking engagements where you're talking about the investment opportunity with your company. Just be careful of avoiding anything that's going out to a large group of people where the wrong type of investors, those people who aren't the people we just talked about, where those people may be picking up on the message and tempted to invest in you. There can be some heavy consequences to this, such as losing your exemption for the securities laws and causing problems down the line. Don't mention your investment in the media. Don't use Twitter to announce that you are accepting investors. We talked about no mass mailings, and keep records of your solicitations. When you approach somebody, whether by email or send them a letter or by phone call, keep track of who you've talked to about it, because the burden, if you have to prove that you didn't violate securities law, the burden is going to be on you to do that.
So if you've got your business plan all together and you're kind of ready to go out there and approach people about funding, then you probably want to develop an investor packet. What we've listed here are some of the items that you'll find in a well-crafted investor packet. You want to have a business plan, and maybe this is not the full-blown business plan, but at least summarized so that investors get the gist of what you're going after. You don't have to have every nitty-gritty detail in there, but they should understand what your objective is, how you plan to get there. The term sheet is basically, it outlines how the investment might be paid back. And a lot of times this is, well, paid back, but also the offer, if it's just an equity offer, how much you're offering each share for. And there's some certain things on there that you want to have. You want to have, see, I wrote my notes down here. You want to have a term if you're paying back a loan over a certain period of time, the interest rate associated with that. You also want to determine what the price point is for each share that you're offering, and also probably put down how much each piece is. Like, does one share of the company equal 1% or some other percentage point? And then what did you have? You had a couple other things on there.
I had the minimum investment that's going to be necessary. Basically how the company's going to be capitalized. We're talking about how much money the founders are going to be putting in. Lay all that out. We're going to take this much from the founders. We're selling this much in private equity. We're getting this much from a bank loan. Lay it out so that your investors can see, okay, my piece is going to be this much of the total. That's an important piece. And basically it's just all the principal terms that are going to be a part of the investment, so that they know so that they can decide whether they're even interested in considering the investment. And this is often a document that beverage companies come to me for first, because they want to approach investors. The mistake that a lot of people make is they go too early with their term sheet. They put together what they think their terms are going to be, and they put them out to their investors, but then things change along the way. So my advice there would be, try to solidify your investment structure as early as possible, but before you start sending the term sheet out to potential investors.
Yeah, I had a thought on the tip of my head and I forgot what it was.
I can help you there.
Can't help me, crap. So I think what it boiled down to is that you want to do your due diligence to run through the numbers and have a good idea of realistically how much money you need to get this up and running, because a lot of times the numbers change from your first month of planning, and then you do your due diligence and maybe you figure out exactly how much the equipment's going to cost and how much the build out's going to cost, and that might be vastly different than what you originally thought. So just run through all that. Oh, I know what I was going to say. Just the idea that the term sheet, it kind of boils down the bullet points of what the deal is. So if you're getting down to brass tacks with somebody and they need to know exactly what's what, this lines out all the bottom line figures, the interest rate, the term, how much you're asking them to commit to.
And key portions of your operating agreement can be included in that as well, such as if there's going to be a buyback provision where you can force them to sell their ownership to you, you want that to be in the term sheet. If there are going to be significant restrictions on transferability, which there almost certainly will be, that should be in there. Just you want there to be enough that they know basically what this deal is going to look like, and then the rest of this investor packet is going to lay out the finer details of that, like in the operating agreement, the admission agreement.
So after your term sheet, you also want to make sure that you put forth pro forma financials. Pro forma financials is a term that means projected financials. So you're going to project out what your balance sheet would look like, what your P&L would look like, and your cash flow over a period of time. The most common time frame that I see is pro forma for the first month of first year of operations by month, and then annually, or if you want to get pretty detailed, quarterly thereafter. And so you'd have the first year in months, and years 2 and 3 represented either in annual or quarterly segments of time. The cash flow statement is really important because it helps investors see how long does it take you before you become cash flow positive, which is a good sign of health for a business. So that's going to be important to investors if they're sophisticated at all. If they understand anything about business, they'll be concerned with that. And so the exercise actually from last week will be really helpful in helping you see what that pro forma might look like. You also are going to have in the investor packet an operating agreement, so they could see the legal terms associated, what they would be getting themselves into from a legal standpoint. The submission or admission agreement is the agreement that an investor would sign to say, sign me up. And the private placement memorandum, which is a legal issue.
That's going to be a document that's used, and it doesn't have to be exactly a private placement memorandum. It can be just any document that's used to fully disclose to your investors all the risks associated with the investment, all the details of the investment, all the exemption that you're going under for securities laws, and all the representations that the investor is going to have to make in order to make this, in order to do this deal. It's a very important piece of the puzzle, and it's a very detailed piece. I do suggest having an attorney draft that. Not because I need the business necessarily, it's just because it's a very complicated piece of paper and very important.
And it can save you down the road.
It can definitely save you down the road.
A good investment on the front end for saving heartache on the back end.
Absolutely.
So basically, just to kind of wrap up this conversation, you want to put together an investor packet, make it look professional, make it look nice, have all the ducks in a row, and so then you would want to schedule probably one-on-one conversations with interested parties, sit down, practice your pitch, tell them, basically you're going to tell them what your business plan tells them, but you're going to tell it to them verbally. And practice your pitch, present the business plan, walk through the term sheet, point out the important bullet points there, show them the financials, really walk them through, and then the final piece is to make the ask. And that can sometimes be the hardest piece. But that's sort of how you go from having all of your documents ready and then to carrying it through to actually ending up with cash in the bank.
And just a quick follow-up on the operating agreement too. Sometimes your investors will want some input into the operating agreement, particularly if they're putting a lot of money into your company. They may want to negotiate those terms. So be prepared for that. You can always present an operating agreement to your investors as it being a draft, or you can just sign on to it yourself and say that it's a negotiable agreement. In a lot of deals, especially sophisticated investors who hire attorneys to represent them and review these things, their attorneys have to earn their money somehow, so they're going to suggest some kind of change to that operating agreement. You can bank on that. So just be prepared for that. That might be a flexible document at this stage. So we have 5 minutes left, so we're going to buzz through this. And please, if you have any questions for us, if you're going to have any questions for us, start throwing them out there because I think your questions are more important than the slides. We want to address all of your particular concerns.
So how do you manage investor expectations? Just some guidelines to share with you. I recommend having annual investor meetings where you get them in a room face-to-face and you actually interact with folks. But aside from that, quarterly investor updates. So this could be maybe your quarterly financials as well as a letter from the managing member that talks about how things are going, what plans are coming up for the future quarter, general trajectory for the industry, just sort of a management state of the state letter. And another big key is figuring out your investor distributions, because I guarantee you that is #1 priority. Well, maybe not #1 priority, but it's definitely on the mind of every investor. When and how am I going to get my money back? And they're going to ask you, and it's probably going to happen when you have your investor meeting and everybody's sitting in the same room together and you don't want to be caught, without an answer. So think about how you're going to figure out how and when people get paid back. Again, this is an area where there's no kind of bright line guidance. There's no right or wrong way. My rule of thumb is that you want to have parameters set in place that help you calculate how much money is available for payback. So typically, in a perfect world, I would say take your cash available at the end of the year, subtract your current liabilities, subtract a safety cushion, and I think of that as either being X number of months of operating expenses. I like 6, you could go as low as 3, or X dollars that you set aside. This number in my mind is my margin of safety. Okay, so you subtract liabilities, you subtract your margin of safety. If you have any capital projects are coming up in the next 6 months, you need to leave money to buy equipment or expand or whatever, take that out of the equation. Then if you've got something left over, that could be money available for distribution. Again, just kind of a broad rule of thumb. There's no right or wrong there.
And just one more thing on that, always factor in, you'll probably be paying tax distributions, which means you're going to distribute enough of your profits so that your investors can pay for the taxes that are being accrued, even though they're not receiving any money. So all the income the company is flowing through to your investors, they're going to have a tax liability, but they're not receiving any cash to pay that. So you need to distribute enough cash for them to handle that, or else you're going to have some disappointed investors who are receiving what's called phantom income.
And it can be a sticky situation because you don't know how the items that flow through on the investor scale one are going to actually play out on their individual tax return, and you have no idea what tax bracket each individual is in. So the conservative answer is to take the amount of money that each investor is getting in taxable income or in income that's flowing through and apply the highest tax rate, which actually is 39.6%. So if you're playing it safe, you're going to apply the highest tax rate. At least then you know they're covered, and they'll probably end up with extra in their pocket after they pay that tax.
All right, and Eric asked about the investor packet of the terms, the operating agreement, one size fits all, or customized for each investor. Generally, it's going to be one size fits all, but that doesn't mean it can't be customized. We've done some deals where you'll have one investor who's putting in a lot more money than other investors, and maybe they get some kind of sweetheart deal because of that. Maybe they get different lien rights on your property on the assets for a loan. Maybe they get some kind of preferred distribution. But in general, the terms of the operating agreement are going to apply to everybody equally.
So we're at 7 o'clock.
Okay. I think that's another slide.
I think it's just our information. Yeah. If you guys have questions, feel free to reach out to us. Jason, I know that you had a question about explaining some stuff, and you and I can talk offline if you would like. Feel free to email me. That's what we got today.
I think that's it. Email us with questions. Oh, next week is going to be a very exciting live session. A person named Janine Grace is going to be joining us, and Janine is the regulatory manager for the Craft Brew Alliance, which is Widmer, Red Hook, and Kona brands. She is a former TTB agent, field agent, so she's very versed in TTB licensing and reporting, and she's also going to be discussing alternating proprietorships because Widmer in particular does a ton of these. So she's going to be a great guest. I encourage you to tune in live. Thank you all.
Hey guys, bye. Yes, next Tuesday is also at 6.